I'm in Miami, and I'm pleased to say that I'm joined by Nassim Taleb, a distinguished scientist of Universa Investments and the author of the Black Swan. Hi, Nassim.
Hi, honored to be here.
So last time we spoke in October, and since then we had a lot of volatility in the stock market, and the price of gold has spiked by almost 30%. Let's start with gold. What is your take on precious metals now?
So my point is I'm not making commentary on the price of metals, but it's largely structural. The U.S. is progressively losing its status as a reserve currency. You still have transactions in U.S. dollars, and people are storing them gold. It is a problem because we have a deficit, and we need progressively more and more foreign investors. But the current administration hasn't been helpful because they ticked off both their friends and their enemies. So you don't have an incentive to store in U.S. dollars if you know that you could be, your asset could be frozen. You can have confiscation. This is not the right environment for storage in the U.S. currency. And so it's going to continue until we have more clarity about both the policy here and the deficit.
Yeah, so in terms of tariffs, by the way, we still have so much uncertainty related to the U.S. tariff policy. So on the one hand, we see that earnings are remaining resilient for U.S. companies. The economy is doing fine, but we do still see this K-shaped recovery. How big of a concern is that?
Okay, the thing is, I'm not into short-term, commentary, but rather about structural risk and long-term effects of policies. The tariff policy, tariffs can be a smart thing. The execution of that is completely crazy and erratic. It doesn't give you an incentive to invest. So if you know that they're going to have tariffs permanently, you go invest in the sector. You don't even have that. They can change their mind. You know, again, an erratic administration is not helping. And plus, the tariffs are not selected in a way to be rational because they affect a class of the population that's, it is a regressive tax. So it's going to have an effect. If it doesn't have an effect yet, eventually things will show.
On low-income consumers specifically, or just bigger economic picture?
Overall, you have a shift. You've had a shift, for more inequality, and this exacerbates it, and it's not helpful in the long run. And that shift for inequality has been exacerbated by AI.
Let's talk about AI, by the way. So we saw a huge sell-off in the stock market, driven specifically by some AI names. What is your take? What's happening?
Again, it's structural. That historically, if you look at history, the car companies, airline companies, and of course the personal computer. Okay, if you look historically, that those who started the business, the pioneers, are not necessarily the winners. As a matter of fact, they're probably more likely to be the losers. So now people take names of AI and say, okay, these are going to win, let's invest. I'm sure someone's going to make a lot of money in both software and hardware related to AI, but doesn't necessarily have to be these companies because you have a lot of instability, both technologically and, of course, in geographically with AI.
So does it mean you expect bankruptcies in, let's say, software space?
Definitely. Plus, the effect on the stock market, as you realize that the previous rally that we had was driven by a very small number of names. And now we probably have some rebroadening effects, some redistribution. But a lot of the gains in the stock market, are going to be eradicated by that. So this is why we're at a juncture of a lot of instabilities across many domains.
And by the way, Universa's annual return on capital is higher than 100%.
Yes.
So what's behind that?
Well, first of all, tail event, but you go ask Grok. Grok represents what we do a lot better than commentator and understands the nature of our strategy. And remarkably, this is an area in which AI has been beneficial to us because they're very coherent in representing what we do for a living. You can ask, and we asked it on Twitter, and it was very accurate. So basically, we work on hedging our client against crises, and it's very nonlinear. We make a lot more during a crisis than we have exponential returns during these drawdowns, And even though the market comes back, we retain a lot of these gains.
So, considering everything that what we have already seen in the stock market and this volatility, do you feel this volatility will continue and people still need to be hedged?
You always need to be hedged because basically these drawdowns are not predictable, easily predictable. We don't have enough volatility compared to the risks involved. The risks are a tail risk, they don't show early. As I said, we have a deficit problem. We have to borrow more and more money every year just to pay for past sins. And then we have this geographic instability, the geopolitical problem. I think that this is not safe. So let's forget about current volatility. It's not representative of the real tail risks that we are facing.
And let's talk about geopolitics, by the way.
Yeah.
One of the most important things that investors are watching, tensions between Iran and the United States.
Yes.
The main risk right now is that if Iran blocks the delivery of oil from the Gulf Coast, some people are saying that the price of oil can spike to as much as $100. How big of a risk is that for you?
The first thing is, it has been very hard during history, particularly with oil, to predict the effect on prices. I remember the first Gulf War, a lot of people were predicting a war by buying oil. Mm-hmm. And of course the war was correctly predicted, but oil collapsed. So we don't know. Oil is very unpredictable. But let me say one thing here. The world today, the Western world, the United States and Europe, cannot afford another oil shock like the one we had in the 1970s. For those who remember what happened then, it's in both inflation, stagflation that we had, and inflation, commodity-driven inflation, that is not easy to remedy with monetary policy. So you can name anybody. You can bring Albert Einstein to the Fed and it won't have an effect. Okay, so it's not a federal policy thing. So we have to worry about these episodes because you can't do anything about inflation and you also can't do nothing about the stagnation. So we have to worry about, maybe we should talk to people in Washington to try to be less aggressive in the foreign policy.
Interesting. And finally, what is the most underpriced risk today, and what is the next Black Swan?
By definition, Black Swan is what I don't see coming. But I would say tail risks across all sectors are underpriced. Okay, and they're structurally underpriced. They're even more underpriced now. I think because we can still face a rally in the stock market. So it's a tail risk, not a risk of drawdown in the stock market. It's a risk of a large drawdown. And that one is, I don't think, the stock market, I mean, look at the risks we're facing, and we're at the juncture, and we have a government that is, I would say, maybe they're doing good things in some areas, but not good in risk management.
And in terms of the global picture, which region you think is the most investable right now?
I don't comment on, again, investment policies. But I would say, ask me what I do with my funds other than my tail hedges. I'm in metals simply because I see a move, a structural and long-term move, hard to repress, and doesn't have anything to do with opinion or commentary. It has to do with central banks accumulating, BRICS countries accumulating more and more gold because they have no choice.